Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically joining me today would be the man himself, Mr. Michael Becker, but he is on another due diligence assignment. So unfortunately, you have me today only in the podcast. So I always like to do a little coaching and counseling with folks to have them kind of understand a little bit some of the ins and outs of the multifamily business. And one of the things that I don't think it gets played up enough is understanding the physical needs of a property. So when you buy a large multifamily property, the lender, typically us, is going to ask for a couple different things. One is an appraisal, which is really the valuation of the property between two independent third parties that are buying or selling the property. So that is a report that usually is $5,000 or $6,000 to get done. Second thing is we do a phase one on the property, kind of figure out what's underneath the buildings themselves to kind of figure out, is there any petroleum-based EPA concerns on the property that if we ever get the property back, that we're going to be faced with maybe lawsuits from the county or from the government, that we're the deepest pockets in the transaction. And the third one is lender wants to figure out what the health and safety is of the property. Is this property filled with termites and it just looks like it's standing, but it's really all the termites on their backs that keep the building up? And that's what we want to talk a little bit about today, is the physical condition of these properties. And want to make sure that you understand is that if we make a loan on this property to you, it is just not at the beginning of the transaction when you buy the property, but also it could be a year from now, 2 years from now, 4 years from now. Lender may come back and say, listen, if this is a non-recourse loan, we don't have a connection to your wallet because it's a non-recourse loan. We only have a connection to the collateral, the property itself, and the cash flow. So we want to make sure the property and the condition remains the best that it can be, even for the age of the property. If it was built 1965 or 1975 or 1985, we'll take that into account, but we need to offer our tenants, if we're Fannie Mae and Freddie Mac, we call those not tenants, that we call those taxpayers on the property, that the tenants are living in safe and secured units. And so we're going to be a little bit more critical, says Fannie Mae and Freddie Mac. So today we want to talk about physical condition of the asset. And I couldn't think of a better person to talk with us about that is Bryan Amos. And Bryan's been on the podcast for the last maybe 10 years or so. He checks in every once in a while. We ask him a series of questions. Bryan is an engineer by training, but also like a general contractor. He's kind of like the guy that would go out if you were buy a single family property, like an inspector. So when you're going out to kind of figure out, what are my concerns on this property? If I'm buying this property, is there a problem with the roofs, problems with the electrical system, the HVAC? He is not the lenders, but your eyes and ears to kind of figure out about what you have. So I want to have you guys get reintroduced to Bryan Amos. Bryan is with Omni Group. They're based in the Dallas-Fort Worth area. They do a lot of physical due diligence. And so let's talk with Bryan Amos. Bryan, how are you?
Hey, Paul, doing great. Thanks for having me on again.
No problem. So tell us a little bit about maybe your background and then talk a little bit about Omni.
Like you said, I have a degree in engineering and was in a cubicle for the first 10 years of my career and decided I wanted to get out into real estate and loved real estate investing. And in 2009, started doing physical assessments, due diligence for investors. First, it was just one-off and here and there, but it just grew organically, where they wanted someone on their side, an advocate in their court, to really evaluate a property. Been doing that for now 17 years. When we first talked, Paul, I think I had dark brown hair. Now it's turned more gray. I think this market has turned a few more gray hairs as well. But I've looked at nearly 100,000 units, a couple of $1 billion in property value, and seen just about everything from Class A plus, brand new construction, to vintage 1940s properties that we've looked at. And really, over these last 15, 16 years, the market has gone up and down. But nothing, what the due diligence calls for really hasn't changed. You see how the investor responds to what you find is a lot different, but really the facts on the ground of the property, of what we try to bring to the investor, those basics haven't changed.
Talk to me about what you're seeing today. I mean, we talked about the ups and downs, but what are you seeing today in terms of the quality and condition of these apartment buildings offered for sale or offered from a foreclosure? What kind of condition are they in right now?
Right. And I think this is one of the main points I want to talk about and why you brought me on. This is what I'm seeing in the last 6 to 8 months is really different than what we had a couple of years ago, because we're not seeing as many transactions. You're not getting this infusion of capital like we used to have every couple of years. And recently, we look at properties that they've had no funds to go toward their capital expenditures. And so this deferred maintenance is increasing. And I'm seeing properties, it reminds me of when I went back, when I first started my career right after the recession, the Great Recession, and you had these properties that hadn't been worked on for a few years because they just didn't have capital. And we're seeing that again, where there's just an accumulation of deferred maintenance, where they spent all their money. Well, the money had to go to the lender as these rates increased, and it wasn't going to CapEx. And I'll still align from Investor Network Group that I'm a part of, that it's really a problem when these non-recurring expenses start recurring and you don't have the capital to deal with them.
So you brought up an important point. It said if you went back to, say, 2013, so when someone bought a property in fairly bad condition, they were buying it as a value-added property. And so they would stick in, at that period of time, in say 2013 or even 12, they'd buy this property and stick in another $3,000 to $5,000 a door in upgrades to the property. And then somebody would come in probably about 3 or 4 years later, and they would kind of, because there was meat on the bone, they would stick another $3,000 to $5,000 in per unit to the property. And then 3 years later or 2 years later, at that period of time, someone would come in and buy it and then stick another $3,000 to $5,000 into the property. So for the last, say, 10 or 15 years, we've had every 3 or 4 years or less, we've had people, when these property changed hands, they'd stick more money into the property, updating the property, doing exterior repairs to the property, making sure the appliances were all working, that they were the top-notch electrical systems and HVAC systems, and they were trying to bring value to it so they could push rents even higher. And only in the last, say, 2-3 years, where interest rates rose, is what Bryan was saying, is 550 basis points. Money has been going to pay that annual debt service and trying to create some type of way of trying to get out of this deal, try to sell it or try to pay down the balance to make even cash flow, be able to refinance into a Fannie Mae or Freddie Mac loan. But the condition, because you're not sticking money in every couple of years on these B and C properties, keeps getting worse and worse and worse. That is a serious, serious problem that it's starting to look like it was until 2011, 2010. Just like Bryan said, coming out of that great financial crisis, these properties went from just being older 1973 and 1968 properties to now there's some great concerns of quality and condition of these properties. There's only so many times you can put rehab number 1, rehab number 2, rehab number 3 together without putting significant cash into these deals. And so when you're out, Bryan, looking at some of these properties, and you just recently looked at a property that was probably built in the late 70s or so, tell me on some of the condition points. And again, walk me through when you walk into a property, what you're looking for.
One point I want to make that echoes what you're saying is that you can only caulk and paint so long. It only lasts so long. And in the last few years, where multifamily frenzy maybe was the highest, that even that wasn't being done in some cases, right? Because their margins were so thin, they were trying to get the property, purchase it, and they didn't have enough in their rehab budget. Maybe they were depending on the last 2 or 3 years of maintenance that they've done, or the last buyer had put in a lot of work. And so they just kind of rode on the coattails of some of these. Now it's even longer, and caulk and paint only lasts a couple of years. And let's just say new material will last, say, 10 years. But really, everything has a time clock. Everything has an average useful life. And so that's what we're going through when we're looking at different systems that have an average useful life. So you mentioned the property we just looked at, and it's one actually I had done 10 years before, and major rehab had been done on it. But, time tells the tale. Over time, things deteriorate. One of the problems they had is the roof had a leak. So the roof was a problem. And, this is mandated by the lender. The city's going to come in. So they fixed the roof, but they didn't fix the damage that it caused for the units. So this is a property that recently sold, but in the last year, they hadn't been able to fix these units. So there was a couple of units that had water damage that just have grown mold, and now they need to be remediated. Right now it's a more severe damage, severe problem to turn those units. So that's what you're kind of seeing, where people are sitting on repairs they can't really do until the property changes hands. So we go through all these major systems. We go through the roofs, the foundation, and plumbing. Now, plumbing is something that you can't really see. I always recommend at some point in your due diligence that you scope the plumbing lines, because this is an example of, 1970s, you had some cast iron, and then they had some PVC. How much? PVC didn't start to be used until 1980s. Sometimes you have repairs that are PVC that last 100 years versus cast iron that lasts 50 years. Well, some of us who were born in the 70s know that 50 years that time has come up, right? So you start to have more deterioration in cast iron in these 60s and 70s properties. This is something the lender will not necessarily look at, that they won't scope the lines. That's why you bring in an expert to coordinate that. Along with the plumbing, we're also looking at major systems like electrical. In this particular property, the panels were older, and this time around, they've called to replace them. Now, everyone should know about Federal Pacific panels. So these are panels that were installed in the 80s, very prolific throughout a lot of multifamily properties. And when I first started doing due diligence and turning my reports to the lender, they were okay with these panels. But like many things, their criteria continues to tighten. So now they have to be changed out. Similar, this is another brand of panel that needs to be replaced. So this is something that they didn't have to do maybe 5 years ago, but you have to do now. Because as you say, these lenders are becoming more and more particular when they put the money into this property. Like you say, the lender is the biggest partner on this deal. And so they're being very cautious, is what I'm seeing today in this market.
I want to make sure people understand of what Omni Group does. So again, we're the lender in the transaction, let's say, and we're going to look as the eyes and ears on the behalf of the lender. So we do, again, the appraisal, the phase one, and the property condition report. Again, those are all reports for the lender, not for you as the borrower, but for the lender. What Bryan and Omni Group do, they're for you. So a property condition assessment report for, say, Fannie Mae is not going to scope the plumbing pipes. Bryan, who coordinates with the plumbers to throw the cameras down the lines to look underneath, 5 feet underneath the building, to kind of see if there's cracks or there's bulges or there's tree growth that go through these plumbing lines, that these could be a serious problem. Bryan, talk a little bit about if someone did not do the scopes and did not understand what the costs are to replace some of these lines that are 5 feet below these units. Tell us a little bit about that.
I like to say I'm a coordinator of experts. So we bring in the master plumber, we bring in a master electrician, we bring in roof experts, foundation, and we have a crew that walk all the interiors, not just a sample, 100%. It's important to check these things that maybe are not in the lender's scope, or not as important for the lender, but they're very important for the investor. And so one thing, when you have these kind of potential problems like plumbing, it becomes very expensive to change out these lines. I know personally, we owned a 60s property, and we continuously had to maintain these lines. So spot replacement, repair, water leaks. And that's one thing you want to try to avoid if possible, or you have it in your budget. You kind of account for what needs to be done based on the condition of the lines. So cast iron will deteriorate, and if you have to clean that sewer line many times, you run that sewer machine, the bottom gets worn out. And so that's where you have roots grow in, and it becomes an ongoing issue for the property and for the tenants.
It is similar to like an iceberg. You only see what's above the ground, above the water line, but when the real expenses happen, probably sometimes underneath the slab on these properties where you think you're getting a great deal, but you failed to do any of these physical repairs to the property. So down the line, after you bought the property, you will figure out that there's going to be some significant costs that you're going to have to put in to these deals. So having Bryan and his team, or having a company similar to Bryan, whether it is outside the Dallas-Fort Worth area, is going to be critical to your success going forward, because as we all know, like Bryan says, we think these are one-time fixes, and they continue to be one-time fixes every year going forward during the period of time that you own the property. One of the things that I want to talk a little bit about is there's not a lot of transactions going on, just because multifamily right now is a little bit out of favor. And so values are kind of collapsing. At least that's my take in the market of not just Dallas and Fort Worth, but throughout the nation. I think they're starting to form bottoms, but they've been falling for the last, say, 2 years or so. Not as rapid as it was rising back 4 or 5 years ago, but falling at a proportional measure, coming down, just like letting the air out of the balloon. So I'm concerned that these properties are not being, when people are going to buy them in the future, that you have to have a professional set of eyes looking at these properties on your behalf of your investors, of what to expect in the future for additional costs on a going forward basis. Bryan, talk to me a little bit about when people want your services. One of the things you mentioned is you walk all these units. Now, a lot of people may have a crew, whether it's a multifamily management company that wants to walk all these units, but you guys walk these units every day, day in and day out, and your crew knows exactly what you're looking for in terms of what the condition of the asset is on the interior, whether it's the appliances or backsplashes. You kind of put together a capital repairs breakdown too. Talk a little bit about when you're walking these units.
I think it's very important to walk nearly 100%, right? Our average is about 97%. Our goal is 100%. And why is that important? Because it's those last few units where we found the most significant damage. So if we don't get in those units, we need to know, hey, is this unit okay? And we give some other verification, like maybe the property management knows it's fine. But our goal is 100%, is because that's where the skeletons in the closet, so to speak, are found. And so we have a 90-point checklist that we walk through, and my team are experts at determining what needs to be done in the kitchens and the bathrooms, the high cost areas, the flooring, and 70% of the value of the unit is in the kitchen and the bathroom, and then the flooring. Then the rest is nice to have fixtures, so we can get in and out very quickly and get a really accurate cost estimate for what it takes to renovate, to turn that unit. It's not a lot of extra effort, but we have a systemized, organized team that can really go through quickly. And when you mentioned the lender is going to do a small sample, small in our mind, 10, 15%,
right,
and not 100%.
So you have put together, I thought was very good, common errors that cost operators millions. And I think you could send this out to anybody that would want to get a breakdown of what you're seeing, your years of experience of physical scope of these properties. Let's kind of go through a couple of these things and let me get some of your feedback. Severe CapEx underestimation. Some of these folks, when they buy the properties, the general partner thinks they know what the costs are to keep these properties going, but sometimes they don't ask the right people. So talk a little bit about underestimation of CapEx.
Well, we do unfortunately run into that sometimes when the property management companies ain't running the renovation, right? They're creating the scope. And I think you need verified experts in those areas that have a lot of experience, and they're not just trying to to get you a bid. We have to vet our vendors that we use very thoroughly, and they have to be experienced in multifamily. Sometimes if you get the cheapest vendor, they may not cover the whole scope. And so then you can underestimate what really needs to be done. It's important to bring the right team to fully evaluate the property. And otherwise, you're going to be rather optimistic on what you think needs to be done, and the reality may be a little more costly. One of the things that I see also in this market is that roofs are very expensive. And many times, if you have a roof vendor, you need to know that you can trust them. Okay. So maybe you're out of the DFW market, you don't have access to our team, but you need to get several bids if you're checking out a roof, for example. I would do this across the board, but you need to have a vendor that you can trust, because many times they'll call out maybe roof repairs, and it's not really something that is an immediate repair. So you got to know where to balance that, something that is really a serious issue, an active water leak, versus you just have a couple lifted shingles. And so it's knowing that by experience, what really needs to be done so you can get your estimates accurate for during your hold period.
Again, my concern is that a lot of these properties have not been repaired or maintained for the last 3 or 4 years. And so when you're out there looking at these properties today or tomorrow in the future, that the condition, I think you'll be shocked at some of the condition on some of these B and C properties.
One thing I want to note is that we're in North Texas. Hail damage is pretty common. Hailstorms come through every spring. And what's happened in multifamily is the insurance rates have gone up. Many times the deductible went from $25,000 to $100,000 to 2% to 3% to 5%. Unless it's catastrophic, you can't afford to put a claim on roof damage caused by hail. I would say, so my sample, I was doing free, we do free inspections for hail damage, and 25% of the properties that I've looked at have hail damage, but then they couldn't do it because the insurance was they were underwater on how much it would cost to do the roof repairs or roof replacement. So that's something to be aware of when you're buying these properties. You need someone to actually get up on the roof. So many times the lender's inspector, they just take your report, or they just assume from what they can see from the ground that everything's okay. Hail damage, you can't see from the ground. So you got to get up there and physically walk that. Or I know some people use drones with the latest technology. I like to actually feel and see how the roof is performing. So that's something to be aware, that many of these properties that have been held the last few years haven't had the funds to do the roof replacement because of insurance. But it's something you would want to do when you take over the property. And certainly it's a concession that you could have in your pocket when you're looking to purchase.
Let's go back to the common errors that cost operators millions. Inaccurate turn forecasting. What does that mean, Bryan?
This is why it's important to do 100% and have a graded checklist on where do these units rank. We rank from 1 to 5. 5 is an excellent unit, and 1 is a heavy turn or a down unit. It gives you a quick overview of what you're looking at when you're going to take on your interior renovations. I know lenders are very motivated to get you to upgrade these units to be able to raise rents, to be able to perform to your pro forma. And it's important to really know accurately the state of all your units. Unless you walk all the units, you don't really know. You're just assuming. And I would say this is important on older units, older properties, and newer properties. I remember one, Paul, that I did for you and a client of yours that was new construction, but one of the vendors or somewhere, they had left the water on the 3rd story, and the water had dripped down to the 2nd floor, to the 1st floor, and caused water damage. And this is a new construction. Normally the desire is just to maybe just do a sample because you're sure they're all right. But we did 100%, and we found this water damage that otherwise wouldn't have been found. So that's why you want to make sure that you really know the state of your units.
How about going back to common errors that cost operators millions? Mechanical system blind spots. You come across that very often?
Yes, unfortunately. So this is when you have your property management company do these kind of inspections for their clients, many times, unfortunately, they don't have the skill to really evaluate what the condition is and what the solution may need to be. You have these older systems, 60s and some 70s properties that have boilers and chillers. Well, like I said at the beginning, everything has a useful life, a timeline. And many times those are at the end of the useful life. So that can definitely cause you problems during your hold period. And then in more recent years, you have individual ACs, and those also are very expensive. Summers are hot here in Texas, and you'll have a lot of those ACs that need to be changed out. Well, you need a detailed survey of the age of those units, what type they are, what Freon they use, so that you know to put together your budget. Otherwise, it's going to be a blind spot for you while you're holding the property.
A lot of buyers, when they try to retrade these deals, they try to do it just off of maybe a lowering of the NOI from 1 month to the next. And they're saying, hey, listen, we think the value is coming down because the NOI is dropping. But one of the true problems is not just the NOI, but the condition of the asset itself. Do people that have this type of report that you put together, could they use that report to try to renegotiate possibly a lower sales price?
I like to be a fair advocate for the buyer. So I'm on the buyer side, but I believe that pictures and clear bids tell the story. So if I'm able to show it, either we do videos for all our properties when we do due diligence, and we also have lots of pictures. So it's incontrovertible evidence for the seller is going to see it and go, okay, we have to do something about this. And so it's not on the purpose of just to beat up the seller, but it does show here's the true condition of the property. And when I first started in my career of doing due diligence, my reports were often used to show, hey, we need a concession, we need to reduce the price because of certain things that we brought up in the report. And then kind of in the more frothy time period of multifamily, I would bring the same conditions and the same problems to my client, the seller, and they wouldn't always, my client, the buyer, they wouldn't always take my advice. So I actually had a couple of properties where I pulled them aside. This is the buyer. But you weren't on these deals, Paul, because you're very involved. Where I pulled them aside and said, look, this property is not worth pursuing. You need to exit. You need to cancel the contract and not go forward. And their attitude was, hey, I'm already down the road. I'm already in this transaction. We're raising funds. I'm a syndicator, and we're going to move forward. Well, I can tell you, one is no longer in this industry, and the other had a severe loss on this property. So take the report seriously. Now you're seeing that we've come back to where I started in my career, where the reports are very important for not only knowing your budget, but also where are we finding the right price for this asset based on the condition? Because you are seeing these deferred maintenance, these large ticket items that need to be accounted for, like your roof or your foundation, or these mechanical systems we mentioned. It's very important to get us involved as soon as possible, right? We can do a evaluation before you have your PCA and while you're in negotiation. So we do some preliminary reviews. We work with some investors to kick the tire, so to speak, of properties. And some of our clients are able to get an early access agreement that's strongly recommended. So you can kind of price where the renovation is going to be. And then you can negotiate before you are even into your PSA. But certainly once you have your PSA and you're in the due diligence period, definitely you want to engage someone who's on your side, someone who can clearly cover all the areas of concern and not just depend on the lender scope or the property management team to do that for you.
Especially if that property management team that you want to hire is affiliated currently with the seller. They're not going to divulge all the problems, all the warts on the property. So you really want a third party like Bryan and Omni Group to go out there and take a look at the property on your behalf about really what's going on, especially if they're going to produce a verbal report and then have pictures. Whoever the seller is, let's say they're out of town and the last time they were at the property was a year ago. They've never really seen it or walked unit number 110 or walked unit number 232. And then Bryan and his crew have, and they're showing you pictures of mold all over the ceilings, all over the floors. And that's a real cost to get these repaired. So you're able to negotiate with the seller or even these banks that have no idea of what they've foreclosed upon now and the condition of the asset. I want to bring up an important point because I think when we do a loan on the property, again, we do the appraisal, we do the phase one, and then we also do the property condition assessment report. Again, these are all reports on behalf of the bank, the lender, Fannie Mae and Freddie Mac into the deal. So we think that report is going to hold for the lifetime of the property. But if we made a loan back in, say, 2019, and for some reason Fannie Mae is doing their annual inspection and they drive the property and they see maybe a little bit of exterior maintenance, they may go back to the lender and say, hey, listen, we want a new property condition assessment report to kind of figure out what's going on with that property. Again, the borrower and lender said, well, we did it back in 2019. Why are we doing one in 2026? It's because we don't like the condition of the asset. So get that put together. So that's maybe a $5,000 cost to do that. And it's like pulling a piece of string that the exterior, they're going to not only just do the exterior, but they're going to look at the interior of the property too. And they're going to figure out that maybe there is some issues on the interior of the property. And maybe we are saying that maybe could be $300,000, $400,000, $500,000 worth of work that needs to be done. And by the way, if it has Federal Pacific panel, like Bryan was talking about before, that was acceptable in 2019, well, Fannie Mae changed the rule book back in March of 2025 that you got to get those panels out of there. That now that's on the new PCA that you got to remove all those panels. Well, wait a second, in 2019, I didn't have to do it. Yeah, but it's not 2019, it's 2026. So Bryan has come up with a couple different things. One, that initial PCA says that you need a couple $100,000. He'll take that PCA and go out to his contractors on this and figure out, based on the scope that Fannie Mae wants to do, to kind of figure out what the real cost is. Not what Fannie Mae says it is, but based on the scope of the work, what the true cost is, which could be several $1,000s less. And then they'll look at on that new PCA that you just got, that we need to switch out those Federal Pacific panels or whatever needs to be done based on the scope that Fannie Mae wanted to be completed. They'll go out and they'll price out what the true bids are, not just what Fannie Mae says it is. And most of the time, Fannie Mae will accept, based on the current scope, they'll accept what Bryan's contractors are able to do. So it's kind of a one place that Bryan can get that number down lower, because sometimes if you don't do that work the PCA says needs to be done, that may be a violation of your loan documents, and if you don't pay it, it may take that loan from being non-recourse to recourse because you're not keeping and maintaining the condition of the asset. So that is a very big thing, is trying to reduce, and it could be needed stuff that needs to be on that property, but the scope gets re-looked at is the same, but the pricing is going to be a lot different from what the engineers that the PCA companies are going to be able to be done versus whatever the street is today on the correct pricing. And Bryan calls that the Omni PCA advantage. So maybe ask Bryan, what's that all about? What did I miss about that?
It's important to think about why would the lender's PCA maybe have overinflated pricing or not accurate to real world costs, is because they use tables, they use charts, they use insurance numbers, and they're trying to be overly cautious. I mean, in my opinion, they're overly cautious. For them, they're just being cautious. But they're making sure that everything is covered, and they're using charts and tables to do that. And we come in and use actual vendors and get real accurate pricing. So, for example, I had a client that the lender came back, did one of these inspections, and called for another PCA and came up with over $1 million in deferred maintenance that had to be done. Well, my team and I, we tackled that and got actual bids. We had to bring in a structural engineer. Sometimes you do have to bring in these other resources, but you also need to know that you can reduce that amount. If you work with either the inspection company directly, you have someone like Partners, AEI, these firms that are preferred vendors for Fannie and Freddie because they write toward those loans, that you can actually reduce this cost, reduce what's being held back either at the beginning or when they come back and do another PCA on the lender's side. That, in my experience, that accurate bids with documentation and pictures always beat an estimate from a table based on a chart of repairs from the PCA. So we're always successful, in my experience, of reducing that or getting a more accurate number. Maybe it's not zero. Maybe there's still some things you have to do, but you have an exact, accurate pricing. And oftentimes we can do that in the period of it takes to produce this report. So if we're able to get a preliminary report from a provider like Partners, we'll work quickly over the next couple of weeks and be able to get all these priced out. So that's what we've actually done that in the last several months. And so we're going to continue to roll that forward as something so we can add value to the current owner and reduce that cost to do those repairs.
So one of the things that Bryan also does, because not only is he an engineer by training, but he also is a general contractor, a commercial general contractor. Talk a little bit about some of the rehab that you do, because we all think, well, it's great to get these reports, but who's actually going to do the work to get it done? Bryan is kind of the coordinator to make sure that all that work gets done. Talk a little bit about that, Bryan.
The only reason we have a construction company is because so many have asked, like you mentioned, hey, you give me all these items that need repair, who's going to fix them? 11 years ago, we started a construction company to serve my own properties and select clients. So, because you have to have a trust there, because I don't want to be, hey, here's all these problems and now I will fix them. They're really two separate companies. So I work wholeheartedly on the due diligence side, and they can take those bids and run with those with their own team and their own crew, or we can take care of it for them because I started out as in being construction management, operations, and executing these repairs quickly and cost effectively, and then being able to go to the lender and proving that we've done it. So that's why we're so successful on the PCA advantage of being able to get these accurate bids, is because we know what the lender is looking for. And so on the construction side, that's what we do to provide updated reports to the owner and to the lender. As we progress, we can really handle all aspects of the renovation from top to bottom. And it takes it out of the hands of the property management company. If they don't want to do that, many times property management company is busy managing the property, not necessarily the entire renovation. So larger firms can have a construction manager in-house. But if you're starting out, beginner, and you're not sure about that, I really help a lot of beginners starting in their multifamily career, first to evaluate the property and then to carry out all the repairs as a trusted advocate, because we're on your side from the beginning to the end.
Are you seeing similarities today as you once saw back in, say, 2012 or 13 when this multifamily house on fire kind of started?
Absolutely. So it seems there's fewer transactions right now, but there's larger renovations. We're actually shifting more to the construction side because there's not as many transactions and more needs to be done once you take them over. It's like same song, maybe not the same song, but similar tune, similar deja vu perhaps of where we're at. But it's definitely an opportunity for buyers to get well-priced assets. And if they set up their renovation and their plan and their budget properly, it looks like a win for investors going forward.
All right, let's wrap this up. If somebody wanted to get more information about Omni Group and Bryan Amos, what's the best way of getting a hold of you?
You can go to my website, theomnigroup.com. That's THEOMNI group.com. Or you can email me, Bryan Amos, BRYANAMOS @theomnigroup.com. Or just text me. I'm available, 214-755 5921.
So Bryan Amos, thank you very much. I mean, Bryan's been a trusted member of the due diligence team around the Dallas-Fort Worth and Central Texas marketplace. If you're a buyer thinking about buying a property and you have any concerns about the condition of the property, you want Bryan on your team to kind of talk a little bit about it. And again, I have no financial impact on Bryan at all, but I think I have no horses in the race with Bryan, but I think Bryan does a great job. He would do a good job for you. And I think that it's worth it to have third-party set of eyes to take a look on your behalf about what's going on the property before you spend a lot of money of other people's money, whether it's the lender or it's the investor in the deal, to go hard with buying this property in the condition that it's in. So Bryan Amos, thank you very much. I appreciate that. Again, I'm Paul Peebles. We'll look forward to seeing you next time on the Old Capital Podcast. Thank you.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.